my muni yield curve is a bit different than what we have for U.S. Treasuries.
Okay.
The biggest difference that we have between the muni yield curve and the Treasury curve is really that we're upward sloping. So this is the U.S. Treasury curve, and this is a little bit dated, but you could see, and to your point about it being inverted, about it bumping all over the place. Now, certainly after the Fed funds cut, that this moved down a bit, but just really illustrates, I think, a couple things. One, that this black line is muni on a tax equivalent basis.
Yeah.
And what you'll note here is that it is pretty much upward sloping. And certainly after the Fed cut of 50 basis points, we really do have some distance between twos and tens now.
Yep.
But it's really remarkable in that as I look at this, the difference between, say, the 20 and 30-year U.S. Treasury, and this is still the case, it's actually a negative slope.
Yeah.
On the muni yield curve, it's just a persistently upward sloping curve. And I think that's really interesting for our marketplace because it's this radical notion that if you go in and lend someone money for a longer period of time, you get paid more. And, we have a curve that does follow treasuries, but it doesn't follow treasuries closely. And I think that's mainly because if you look at the muni market, we haven't grown in 15 years. By that I mean, in the last 15 years, the U.S. muni market has only grown on a cumulative basis 5%. The treasury market has about more than tripled. And so we don't have the supply issues that you see with the treasury market needing to finance a $2 trillion deficit. We have just a relationship that is, I think, a little bit different than treasuries because we just don't have, we have some of the credit issues on the muni side, certainly, that you alluded to that treasuries don't, but we just have a different dynamic in that the supply of munis has not been what we've seen in the treasury market, which has to go in and finance a $2 trillion deficit.